Hello value investors, thank you for joining me. Today I want to talk about Cloudflare and why I think that Cloudflare is an interesting opportunity but probably very richly valued. So my name is Michael from Deep Value Returns on Seeking Alpha. Okay, so let's get started. Cloudflare is a CDN, content delivery network, and essentially if we look back to last year, this was a new opportunity, and together with Fastly, these two companies were just like growing really fast. At one point, Fastly was up 400% year over year. It was just crazy. People were just going bananas, and Cloudflare was kind of like a close peer, but it wasn't really growing at that kind of level. Look how much things have changed this year. In the graph here, you can see that Cloudflare, even in this year when high growth names have really kind of fallen out of favor, Cloudflare is still up about 37%, whereas Fastly is actually down 37%. So you can see how that's really shifted the dynamics here. Now, there's a quote from on Ben Graham's security analysis that he talks about many shall be restored that now are fallen, and many shall fall that now in honor. So this is obviously a quote from Horace, but it talks about mean reversion. So is it possible that Cloudflare is just taken off and slightly detached from reality, or is it a case that investors are recognizing that Cloudflare is a really good business and they're willing to pay a premium for that? So I think there's a bit of both in this sense. So on the one hand, Cloudflare is doing really well. So you can see non-GAAP gross margins at 78%. This is really high. On the other hand, if you look out, you can see that Fastly's business model is much more predisposed to enterprises, and even in that case, Fastly's gross margins are only 60%, so that they're approximately 10% points lower than Cloudflare. So obviously Cloudflare is doing something really well here to be able to have those kind of gross margins. On its long-term prospects, it's saying, okay, investors, we think that we have a long-term model that can reach approximately 20% operating margins. Now, if you look back to 2020, it had negative 8% of gross margins. This year it's guiding for approximately negative 4%. So there is an improvement year over year in 2021, but it's still quite a distance from positive 20% operating margins. So it has a lot to prove itself still. On the other hand, I just wanted to point out that Cloudflare's dollar-based net retention reached 123%. Just to remind you, that shows that the same cohort year over year, they've been able to upsell 23% more in services and got more revenue in. So that's a sticky customer being able to upsell to the customers, and as you can see here in this graph, the number of customers going in is up 27% year over year. So more customers, sticky customer, and upselling. Great, right? So all that considered, the company is just so stable here at approximately mid-40s CAGR. So it's coming off very high growth rates last year when it's growing at close to 50% year over year, and is still pointing for the guidance to come in at mid-40s. So it's just a business that has a lot of tailwinds, is doing really well. Now here's the problem. The company is priced at 53 times forward sales. Okay, that's really punchy. I know a lot of names in SaaS and in tech, and this is just like wow out there. If you want to compare with its peer Fastly obviously has hit a bit of a tough patch, but it's priced at 18 times forward sales. So that's like a fraction of what Cloudflare is going for. Many that follow the cybersecurity space would say, okay, security is such an in thing right now, but even the leader in cybersecurity, CrowdStrike, is priced at 42 times forward sales. So CrowdStrike, if you follow this space, is one of the ones that people say, that's really punchy. Datadog is approximately 35 times forward sales. So Cloudflare is just really out there, and for a company that is not even anywhere near to break even on the profitability line, it's probably a bit punchy. I'm going to stick around to look for something with a few more hairs on it, a bit cheaper, because I think that the risk reward can be improved here. If you want to know which stocks I own right now, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why come in, do a free trial, see if it suits you. If you like it, stick around. If you don't, no harm, no foul, right? Okay, see you next time. Bye.